This is the first video for revenue recognition. We're going to talk a little bit about consignment inventory. You may or may not have been exposed to consignment inventory, or hopefully you've read the chapter and understand what it is. But essentially what consignment inventory is a company engaging another company to almost act as a sales agent on their behalf. So if we look at the graphic that's up here right now, pretend that we're the red store right here on the left hand side. So we're the store. We're located in London, Ontario, and we sell bicycles. What we'd like to do is we'd like to be able to sell bicycles all the way on the west coast out in Vancouver. The issue is that storefront space in Vancouver is very expensive. We can't afford to set up our own store. So what we think we might like to do is contact a store in Vancouver and say, hey, would you like to act as a sales agent for us? What we'll do is we'll ship you a bunch of our bicycles, you sell them on our behalf, and what we'll do in return for you is we'll give you a commission. So if we sell a bike for $100 and your commission is 20%, you make $20 on the sale of that bicycle. Right? So the way a consignment transaction works, there's 5 steps that we need to consider. The first is when we decide we're going to ship inventory to that store in Vancouver. Well, for us here in London, Ontario, we want to be able to track the difference between the inventory that we have on hand currently and the inventory that we've sent out on consignment. So what you'll notice is that when we ship the inventory here, point number 1, we actually have to do a journal entry at this point to transfer the amount of inventory that we shipped. We have to transfer it out of normal inventory and set it up as consignment inventory. So the next slide in this presentation, in this slide deck, we'll actually go through all the journal entries. But just know that on the date we actually ship it, the red store here, the date that we actually ship it, we have to do a journal entry to move our inventory to consignment inventory. The second thing we have to think about is what do we do with the freight? Okay, so we've decided we're going to send this inventory to the store in Vancouver, but now we have to decide what are we going to do with the freight, right? We have to pay to get it there. The answer to that question, well, if you think about it, we really have 2 options. We can either expense it directly to the income statement, or we can capitalize it as a cost of inventory. So let's think for a second what we do with freight in. When we buy inventory and we pay to have it shipped to us, what do we do with that freight cost? Do we capitalize it or do we expense it? And the answer is that we capitalize it. And the reason we capitalize it is because we need to include in our inventory all costs that are reasonably required to get the inventory into a sellable position. Right? So we couldn't obviously sell the inventory if we didn't ship it to our location, if we didn't pay for the freight. It's the same situation here. What you'll find is that when we ship inventory on consignment, that what we pay for freight is actually capitalized into the consignment inventory. The reason this makes sense is because we're not shipping it to the end user here, we're actually shipping it to someone else to sell for us. So really that freight is a cost of getting the inventory into a position to sell. Therefore, we have to capitalize it. Okay, so we've decided, so number 1, we're going to ship the inventory, we're going to do a journal entry to set it up as consignment. Step 2 is to actually pay for the freight to get it out to Vancouver, which means that we're going to capitalize that freight cost. Now once it gets to the store in Vancouver, what typically happens is that they advertise our product for us, right? But again, when we send this inventory to this company in Vancouver, it's not their inventory. It still belongs to us. They're just acting as a sales agent. So when they pay for advertising, they're paying for it on our behalf. So typically what happens is that we here in London would agree to pay them back for whatever the cost of their advertising was for our products. Now we'd probably agree on a set price so that they couldn't spend whatever they wanted to sell our product, right? We would have to agree to the advertising campaign and the cost, but we would agree to pay them back. So in step number 3, the store in Vancouver is going to advertise for us, but it's not their expense. So you'll see when we get to the journal entries that they set that up as a receivable from us. We owe them for that. Okay? So we've decided to send something to a store in Vancouver. We've sent those bikes, put them on a truck, paid for the freight. They're now in Vancouver. The store in Vancouver has advertised those bicycles on our behalf. So the next thing that happens typically is that someone comes in and buys some of that inventory. So they sell our bikes, right? Which was the end goal. We wanted them to sell the bikes on our behalf. So we sent them to them, they advertised, they sold them on our behalf. When that customer comes in to pay them, the amount they pay for the bike isn't the consignee. So the store in Vancouver is the consignee. The revenue that they're the cash that they collect isn't the revenue of the store in Vancouver. If you think about it, the revenue of the store in Vancouver is their commission revenue, right? We've sent them bikes to sell on our behalf, and we've agreed to pay them a commission to do this. So their revenue is commission. So when they actually collect the cash from the sale of the bicycles, they owe that money back to us in London. So what they're going to do is do a journal entry to set that up as a payable to us. So when a customer comes in and buys a bicycle, they're going to set it up as a payable. Okay? So this whole chapter is about revenue recognition, right? And you should have read about the earnings approach and how we when we recognize revenue and the criteria that are required to recognize revenue. But you'll notice when we look at the journal entries, through steps 1, 2, 3, and 4, no one as of this point, even though the bikes have been sold, no one as of this point has recognized any revenues or expenses on their income statement. Everything to this point is sitting on the balance sheet, right? It's still our inventory. That's the only thing that's happened. Okay, that's the only journal entry that's happened on our books, is that we've set up consignment inventory. The only two journal entries that the store in Vancouver has set up is a payable to us for the cash they collected and a receivable for the advertising they paid. So it's not until step number 5 here where the store in Vancouver sends a notification back to us in London to say, hey, yeah, we sold 95% of the bikes that you sent us for $10,000. Right? Whatever the number is. So the store in Vancouver will send a notification. It's actually a piece of paper, and it will say, this is the amount of sales revenue we collected, and then these are the 2 things that we're going to withhold. Please find enclosed a net check. So what do you think those 2 things are that they're going to withhold? Right? Well, go back. In step 3, they paid for advertising for us. We owe them that money. Do you think the store in Vancouver is going to want to send us the gross amount of money they collected and then send us an invoice and say, hey, can you now pay us our advertising? The answer is no, right? So what the store in Vancouver is going to do is say, hey, we collected $10,000 in sales for you for selling your bicycles. You agreed to pay us a 20% commission. So that's $2,000. So we're going to withhold that. So now you're only getting a net check of $8,000. But we also paid $500 for advertising. So we're going to withhold that as well. So even though we collected $10,000 on your behalf, we're only sending you a net check for $7,500. We're going to withhold the $2,000 in commissions and the $5,000 or $500 you owe us for advertising costs. So please find enclosed a net check for $7,500, right? So when the store in Vancouver sends that notification, they recognize that transaction. They recognize their commission revenue, they clean out their payable, they clean out their receivable, and they send us a net check. When we get that net check back in London in the mail, that's when we get to recognize revenue. Because it's not until that point that we actually know that the store in Vancouver sold any of our product. So when we get that notification, we're like, yeah, hey, that's great, they sold our stuff. We made 10 grand. We had to pay them a commission, we had to pay some advertising. The net difference goes to, as profit to our income statement. All right? So that in a nutshell is a consignment inventory. The consignee, which in this case is the Blue Store out in Vancouver, they agreed to sell our product for us. They act as a sales agent. But the inventory never changes hands as far as ownership. It belongs to the store in London. This red store here, the consignor, it belongs to the consignor the entire time. Okay? Until sale, and then it obviously belongs to the end consumer. So the store in Vancouver doesn't pay us anything for that inventory. It's a risk-free situation for the store in Vancouver. They don't have to pay us for the inventory. They sell it as a sales agent. Okay? So the journal entries, what do they look like? Well, there was five separate activities that I identified on the other page. Here's the 5 activities listed in a chart. I like the style of this chart because it shows you who has to do a journal entry on which date, right? So let's look at date or activity number 1, when we send the goods out on consignment. So we've decided, the consignor's decided to send the consignee some inventory. Well, on that date, like I mentioned, the consignor, which was us, the store in London, we have to do a journal entry to debit consignment inventory and credit regular inventory, so that we now know how much of the inventory is out on consignment. The consignee, which is the store in Vancouver, on the other hand, has no entry that's required, right? The inventory doesn't belong to them, so they don't need to set it up at their books. They're not buying the inventory from us, they're selling it on our behalf, right? So when we look at the first entry or the first transaction or the first activity, there's no entry on the consignee's part. At most, what they might do is make a memo entry to say, yeah, hey, we received 500 bicycles from that store in London. Here's the brand, the type, the model number, whatever, and the number of units, and they would track it through a memo entry, but there's nothing that goes on their books at that point, so there's no entry. Number 2, when they pay shipping, when the store in London pays shipping to get the bikes out to Vancouver, we already mentioned that we're going to capitalize that cost into the cost of the inventory. So the consignor, which is the store in London, is going to debit consignment inventory and credit cash. That's going to capitalize the cost of those shipping charges. But if you look, the consignee does no entry. If you think about it, that kind of makes sense, right? The consignee doesn't own the inventory, so why would they care what the shipping charges were? They don't have to pay the shipping charges, right? So in no way do those shipping charges affect the consignee. So there's no entry required on the consignee's behalf. The third activity is when the consignee pays for advertising, right? So if we look at our situation, this is where the London store had bicycles. We sent them out to Vancouver to sell for us. Now the store in Vancouver is going to advertise. We might agree to a max amount of advertising that we're willing to spend, and the type of medium, whether it's newspaper, whether we want it to be print, or whether we want it to be radio or whatever. We might agree to the medium, but we don't necessarily know exactly when that advertisement was taken out and how much was paid. The store in Vancouver knows. So if you look, when the consignee, when the store in Vancouver pays for advertising, the consignor, which is the store in London, does no entry because we don't know about it. We didn't pay for it. The store in Vancouver did. The store in Vancouver, however, is going to set up a receivable from us. So they're going to debit receivable from consignor and credit cash or AP. Why does that make sense? Why didn't they debit advertising expense there? Again, because we've agreed to repay them, they're not going to set it up as an expense because it's not their expense, it's ours in London. So they just set it up as a receivable. We have to reimburse them for that cost. The fourth activity is when the consignee actually sells the goods. Again, the store in London, if you look under the consignor column, there's no entry. And that's because we have no idea that the inventory's been sold until we get a notification from the store in Vancouver saying, yeah, we sold your inventory. So obviously we can't do...
Bill Reed, front desk, please to the city of Bill Reed. Thank you.
So obviously we can't do a journal entry to record the revenue yet. The consignee, on the other hand, actually has sold the product. So someone's come into their store, picked a bicycle out, and paid them the money for the bicycle. Typically, if the inventory belonged to them and it was their own bike, the store in Vancouver would just debit cash, credit, sales revenue, right? Well, in this case, they're selling it on our behalf, so that's not their revenue, so they can't record it as revenue. So what they do is they debit it cash, because they received money, and then they credit a payable to the consignor, to the store in London, to say, yeah, we collected this amount, and we have to pay it to you. So they don't affect revenue. So this is what I was saying. If you look at all the journal entries that we've done so far in the first 4 activities, not one of these things has hit the income statement yet. No one's recognized revenue. No one's recognized any expenses. It's not until the date of notification, number 5, when everybody gets to recognize their revenues and expenses. So if we look at the consignee first, right? Because they're going to be the ones sending the notification back to the consignor. They're going to do a journal entry to clear a couple of things out, right? The first is they want to clear out this payable to the consignor. They said they collected $10,000 on our behalf. Once they pay us a check, they don't actually owe us that money anymore, so they don't have to set it up as a payable anymore. So they're going to debit the payable to clear it out, right? And because they're going to withhold, back here in number 3, because they're going to withhold the amount we owe them for advertising, they're going to credit the receivable from us. Because by withholding the money, we've effectively paid them for the advertising. So they debit the payable to clear it out, they credit the receivable to clear it out, and then they recognize, this is the point at which they get to recognize their commissions revenue. So they're going to credit commissions revenue for whatever percentage we agreed to pay them, and I think in our example we said 20%. So they're going to credit commissions revenue for $2,000. And then whatever the difference is between that, the payable less the receivable less the commissions, is the net check they have to send us. So they're going to credit cash because they actually have to pay us, right? So they send that notification to us. We get a little envelope in the mail. We open it up. There's a check attached to the back, and there's a piece of paper, and it shows us the details of all the sales transactions and the amounts withheld. So now we, in London, get to do an entry to recognize our revenues and expenses, right? So a net check was enclosed, so we get to debit cash, right? We have to record a debit to the advertising expense that we agreed to pay them, as well as the debit to commissions expense for the amount that we agreed to pay them. And then obviously we're going to credit sales revenue for the gross amount that the consignee collected. In our case, it was that $10,000, right? So that's what we do on the consignor side to recognize our revenue and some of our expenses, but there's still one expense left that you can't forget about, and that's the fact that we've sold some inventory. So we need to move the value of that out of our consignment inventory and onto the income statement as cost of goods sold, right? So the final entry that's required is a debit to cost of goods sold and a credit to consignment inventory for the value of the inventory sold, okay? Couple of key things. The credit goes to consignment inventory, not normal inventory, right? Because if you look back up in activity number 1, we moved the inventory out of normal inventory and into consignment inventory. The second thing to remember is when you're trying to determine the value of your cost of goods sold, don't forget that in step number 2, we capitalized shipping charges. So the value of our inventory is the original value from step number 1, activity number 1, plus the shipping that we capitalized in activity number 2. That is my total value of my inventory. That's what I'm going to use to help me come up with my cost of goods sold. Okay? So those are the journal entries that are required on each date by each party. If in a question in your homework or on the test, I ask you to give me the journal entries for one side or the other, let's say I ask you to give me the journal entries for the consignor, and I ask you to give me the journal entry on the day the advertising was paid. You need to write in no entry required so that I know you understand that there's no entry required on that date. You can't just leave it blank because I'll assume on the test that you don't know what you're doing. Okay? So make sure that if no entry is required, you tell me no entry is required. So the last slide for consignment is just basically a breakdown, right? Some reminders of some of the key points. So consignment is when we distribute goods, when a company distributes goods, but the vendor, so the consignor, retains legal title. So in our example, the store in London always owns that inventory, even though it's sitting out in Vancouver. Second point there says that the vendor ships the merchandise to his seller and uses them as a sales agent, right? We remember that from the overview. Obviously, the consignor, the person sending the inventory, is going to be the one to record the sales revenue, right? The consignee, the person selling, their revenue is generated through commissions. So they're not going to show a sales revenue figure, they're just going to show a commission revenue, okay? Obviously, if you remember from reading in the text, the earnings approach, one of the key criteria for recognizing revenue was the fact risk of ownership had to have transferred. That's not the case in a consignment inventory situation. So like I said, because risk of ownership remains ours, that inventory still belongs to us, it has to stay on our books. So basically that's the gist of your consignment.